Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And for my video this week, I'm doing something kind of interesting. At least I found it interesting, and I hope you agree. You know, we've gone through this COVID. The market's been crazy. We've got bifurcation in the market. We got stocks that are trading at nosebleed valuations. We also got stocks that are trading at very low valuations. And it's become very confusing and very difficult. And, you know, one of the things that I've done my entire career is I've gone to my investment library routinely. I do it about once a month or so. And I'll grab a book off the shelf, a book that's had a major impact in my investing career and investing strategies and beliefs over time. And I'll reread those books. Now, this past week, I actually did two. I looked at Peter Lynch's book, One Up on Wall Street, which is really, so in tune to what FastGraphs, the Fundamentals Analyzer software tool I developed, does. But then I also looked at the little book that beats the market by Joel Greenblatt, where he offers what he calls his magic formula. And the magic formula is really based on earnings yield, but he looks at earnings yield a little differently than I do. He looks at EBIT to enterprise value as earnings yield. And then he also looks at return on equity. These are the two components of his magic formula that he believes, or he states, has beat the market, routinely, significantly, with a very high percentage over any 3-year period since he's been playing with it or running it. So I found the book interesting. I always learn something when I read those books, and I'd really recommend that each of you read both of those books if you haven't already, because they're excellent works. But what I did was I came up with 5 smaller to mid-cap companies based on Joel Greenblatt's work that I felt were very, very interesting and that I wanted to share with each of you here. So let's go ahead and take a look at the 5 companies I went with. 4 of them are small to mid-cap companies. I do have one large company in the universe, but let's go ahead and take a look. And I've got them in alphabetical order for you here. I've got Allison Transmission, which is an industrial, which makes construction, machinery, and heavy truck transmissions. They're world famous for their transmissions. And then I've also got Catalyst Pharmaceutical, a biotechnology company. I've got EBIX, which is an information technology, which is application software. And then I've got HP Inc., which is the old Hewlett Packard, information technology, which is technology, hardware, storage, and peripherals. And then I've got Supernus Pharmaceuticals, another healthcare pharmaceutical company. These are some 5 very interesting companies. What I want you to notice here is that their PE ratios are actually below my 15 threshold, so therefore they've all got earnings yields above my 6.5%. Their price to cash flow numbers are also very, very low, and they also have price to cash flow numbers that are very, very high. So they also meet my quote-unquote Mr. Valuation criteria. 3 of the 5 companies do pay dividends, and they range in market cap, as I said, from as little as $700 million, $428 million, to as much as $28 billion. But mostly 4 of the 5 are mid caps here. So let's go ahead and take a look at each of these companies individually. I'm going to do them in alphabetical order, and let's start with Allison Transmission Company. And I do want to make a point here that you're very clear on. I'm using EBITDA. Actually, I'm going to switch that to EBIT, which is the requested or the preferred formula or metric that Joel Greenblatt recommends in his book, the little book that beats the stock market. And it's earnings before interest and taxes. And so what you see here is I want you to notice that Allison had put together, since going public in 2012, they've really put together a very good record of earnings. Now, we came into 2020, and of course we had COVID. And I do want you to see something here very important. 6 months ago, we were looking at EBIT numbers of $6.68. Well, today that number's dropped to $4.16, and of course that's because of the shutdown and so on. But I do want you to notice that analysts are expecting EBIT numbers to recover dramatically, over 31% in 2021 and an additional 29% in 2022, which makes this stock look very, very attractive. The company does offer a dividend yield of 1.84%, has a blended EBIT yield of 14.6%. The company does have a lot of debt, but one of the things that Joel Greenblatt's magic formula does is he compares EBIT to enterprise value, and the enterprise value is $6.59 billion, where the market value is only we'll call it $2 billion. So I want to point out that the debt is taken into consideration in the magic formula calculation. The next thing I want to look at then is return on invested capital, because that's another part of the two metrics that he looks at. And we see here, this is the last 7 or 8 quarters or so, and you can see their returns on invested capital have been in the as high as 20%, but even recently through the first quarter of this year, they ended up with 17.75% return on invested capital, which is very, very attractive. So what we've got is a great opportunity here in Allison Transmission that could be, if we own this stock for the next couple of years, be in a position to beat the market. The next company I want to look at is also very, very interesting, and we're going to look at it with earnings before interest and taxes as well. This is a pharmaceutical company, as you know, or a biotechnology company, as I've pointed out. The company's had no earnings whatsoever. They've actually generated losses up until 2019. Then they had 30 cents in earnings, and then they grew that by 35% to 41% in 2020. And interestingly enough, in spite of COVID, the analysts are expecting 51% growth in earnings for 2021, followed by 44%. So we don't have a long track record here, but based on earnings growth, we're looking at a normal price to EBIT of about 12.4. The company's currently trading at a price to EBIT of 11.4 with an EBIT yield, if you will, or an earnings yield of 8.76%. So that looks very, very attractive. Now, if I go to fund graphs, let's go ahead and look at the return on invested capital for CPRX. And it's very, very interesting in that they have this huge return on invested capital for the few years that they've made money. The last couple of quarters, the return on invested capital has actually exploded. It's gone from 13% to 45.8% to 56.7%. So this company obviously has explosive returns on invested capital. It's generating a lot of money. It obviously has to do with what they're developing now, and I'm going to leave that up to you to discover that for yourself. But look at the growth potential of this stock going forward. It's very, very intriguing, and it's kind of refreshing for me to look at a company with those kind of numbers. The next one I want to look at is EBIX. And EBIX is a very interesting company in its own right. What I really was attracted to here, and the reason I chose it as one of my 5, the company does pay a dividend. It doesn't have much of a dividend record, and analysts aren't expecting the dividend to grow. It obviously has a very, very low payout ratio. It's only paying out about 6% of its earnings, but it is expected to grow dramatically in 2021. It's expected to have a down year this year, which again is understandable, but expected to grow 36% both for 2021 as well as 2022. And as a result of an extremely low blended price to EBIT of only 5.4, it has an EBIT yield, if you will, of 18.5% and a dividend yield of 1.25%, as I mentioned. Company does have 55% debt. Its market cap is $732 million, but its total enterprise value, because their debt, is $1.4 billion. But keep in mind, this magic formula that Joel Greenblatt uses does take debt into consideration in the formula, and it's still screened out as one of his selections. So I want to go ahead and look at quarterly returns on invested capital like I have with the others, and we see about a 7% return on invested capital. And the point I want to make is this is lower than what we've seen, what we just saw. However, I do want to point out the extreme low valuation here. This company is trading at an extremely low valuation, but it still has a good return on invested capital, but just not as strong as the other ones that we've looked at. Now, the next company I want to take a look at, of course, is HP, and it's Hewlett Packard. And we have had some cyclicality with this stock. It actually has held up well. Earnings growth, EBIT growth has not, which is earnings before interest and taxes, so it is earnings, have not been spectacular, but they have grown pretty nicely. On average, they've averaged about 6.5%. The company's forecast to grow at about 4.5%. The long-term trend line growth is a little bit less. But the real key here again is the low valuation. It's trading at 6.96 times EBIT, has a blended EBIT yield of 14.38%. And this one does offer an interesting dividend. It's almost 4% dividend yield. And if you look at the company's dividend record, you can see that they have grown the dividend by 8 or 9%. Now, if I look at this stock from a standpoint of when it was attractively valued, it also has a good record. Note that it was significantly overvalued in 2001, but look how price tracks earnings. And what we see here is a very, very low valuation relative to EBIT. So I like this stock very, very much here. If we go ahead and look at returns on invested capital for Hewlett Packard, what we discover, we're going to go ahead and take a look at it quarterly, is the company generates a very, very strong return on invested capital. That's a very, very good positive in my point relative to the magic formula. So I offer Hewlett Packard as a very, very interesting candidate for y'all to consider it. And again, I'm putting these out here for you to go ahead and do your own research and due diligence on. The point is the magic formula has created them. The last company I'm going to look at is Supernus Pharmaceuticals, and it's a pharmaceutical company rather than a biotech. Now, they've had some COVID issues here, as you can see, for fiscal 2020. We had a drop, but we're looking for a very strong recovery. Blended price to EBIT is just under 10. The EBIT yield is actually over 10%. The company doesn't pay a dividend, so this is pure growth. If you look at the company's growth estimates going forward for the next couple of years here, you can see that the estimates were $1.94 6 months ago. They've actually increased to $2.04, and they're looking to go to $2.38 and then to $3.36, and I'm not really paying much attention to what I'm looking at out here. So this looks very, very attractive on a valuation level, and let's go ahead and look at it from a standpoint of their returns on invested capital and see what we see. Again, I'm going to go to quarterly. The company's generating double-digit returns on invested capital over 12%. So, based on Joel Greenblatt's magic formula, it looks very, very attractive. And these are really, 5 companies that Joel claims, his magic formula is screened out. And what he suggests you do here is you invest in all 5 of them. I do also want to make that point. Rather than picking one, you invest in all 5 of them and you own them for at least a year, and then you can even sell them in a year, but then, maybe go ahead and rerun the screen, if you will. But it's something a little different, something I thought we'd have a little fun with. I hope you enjoyed it. Anyway, this has been Chuck Carnevale saying thanks for watching. These are 5 magic formula companies that you might want to take a closer look at. If you like what you see here, please don't forget to subscribe, ring the bell, and give me a like if you like what you saw. Thanks for watching.